Hello and welcome to the January 7th edition of Radix's Rent and Operating Trends Report. The first week of 2024 was a mixed bag from an economic perspective. Major equity indices sold off to start the year, led by the tech sector. There has been some concern that the stock market became overvalued after a surprising and very strong 2023. However, late last week, the December jobs numbers supported the continued strength of the economy. In December, roughly 216,000 new jobs were created, bringing the 2023 total to 2.65 million new jobs. Government and healthcare led the way last month, adding 90,000 of the 216,000 new positions. The unemployment rate has held steady at 3.7%. Multifamily fundamentals had a quiet week last week as the leading indicators edged downward, but rent and occupancy were mostly unchanged. Occupancy remains the focal point for the industry as we weather the winter slowdown. Based on last year's atypical trend, where occupancy was flat through the first half of the year before falling in the summer and fall, I will be interested to see how it performs this year. Nationwide, traffic fell 0.2 tours per property last week, yet average traffic remained slightly ahead of its level from this time last year. Traffic fell in all but two markets last week. Boston and Baltimore were the only markets where traffic increased, and in both metros the gains were minimal. Chicago, Tucson, and Nashville, however, had significant traffic slowdowns last week as each metro lost at least a half tour per property from the week before. New leases signed also fell modestly nationwide last week and remained close to their level from last year. No markets reported leasing growth last week, as flat performance was the best any metro could do. Chicago also trailed the leasing rankings. Occupancy measured a small 1 basis point increase last week. A few southern and western markets in desperate need of occupancy growth received welcome news last week. Miami, Salt Lake City, and Tampa led the weekly occupancy rankings, picking up 12 basis points, 11 basis points, and 9 basis points respectively. Sunbelt markets typically outperformed during the winter, and these markets would benefit greatly from continued occupancy gains. ATR was flat last week, and the average property has 15 units available to rent over the next 60 days. NER was unchanged last week at the national level. Metro-level performance was split as Salt Lake City led all markets. Rents were up 1% last week in the Utah capital. Phoenix, Jacksonville, and San Francisco all had strong weeks as well, providing slight optimism for some of the hardest-hit rent markets. San Diego had a tough week as rents slid 30 basis points. However, rents remain 1% higher than they were a year ago. Austin and Atlanta also struggled last week as rents fell 20 basis points. Both markets maintained some of the weakest rent growth in the nation. Nationwide, revenue per available unit has fallen 2.1% over the past year. While RevPAR remains down on an annual basis, it has improved modestly over the past few months. At the beginning of the fourth quarter of last year, RevPAR had fallen 2.3% annually. It's no surprise that Salt Lake City led the RevPAR rankings last week. RevPAR was up 1.1% in Salt Lake, far outpacing any other market. The next closest market was New York at 0.4% RevPAR growth. Thank you for listening to this week's edition of Radix's Rent and Operating Trends Report. On behalf of Radix Research, I'm Chris Nebenzahl. Thanks again for joining us.